Beginner investors are spoilt for choice in terms of the investment options available, and it can leave you literally scratching your head as to which option to go with. Watch this video to find out which investing style suits you and which investing option suits that style. Hi there, welcome to my channel. Let's talk money and getting more of it. Investing is a lot like cooking. You take some simple ingredients, you put them together, and you end up with a delicious meal. The thing is, we don't all want to be master chefs selecting the individual ingredients, and some of us prefer the easier option. Uber Eats, anyone? This is exactly the same when it comes to investing. And luckily for us, each investing style has a home in this market. So let's break down the choices. Investor 1 is the TV dinner investor. You like the convenience of sticking a pre-made box dinner in the microwave, and you cannot really be bothered with trying new recipes and putting together new meal ideas. And the same goes for your investing style. Talk about the markets, interest rates, and such are like an immediate tranquilizer to your brain, lulling you into a state of total boredom. But that being said, you are very interested in your money and having more of it. You have big goals, and you know that investing is the way to maximize your money and reach your goals. And you are not alone. Target date funds, or as they're also called, life cycle funds, have become very popular with the TV dinner investor. Life cycle funds are created by asset managers such as Vanguard, Fidelity, Charles Schwab, Wealthsimple, to name a few. And they create a number of ready-made portfolios covering different asset classes, geographies, and investment types. And these are designed to broadly match your risk tolerance, and which is basically how many risky assets you're comfortable with holding in your portfolio and your investing time frame. And the idea is that you choose the relevant life cycle fund, you regularly invest your money into it, and you basically leave it until retirement. And the fund will match your time frame across your life. It sounds simple enough, right? So let's take a look at the pros and cons to see if this might be the right approach for you. The obvious pro is the convenience and hands-off aspect, and this is a big pro if you are a TV dinner investor. However, it isn't without its cons. And the first con is that you are 100% reliant on the investment manager for managing your investment profile to suit your stage in life. And this has the obvious negative that it may not do so. Furthermore, as the fund is focused on the stage of life as opposed to stage of the market, you may be missing out on some really good returns in some years and subject to some really poor ones in other years. Secondly, the funds are designed to appeal to a mass audience, so they may not 100% match what you want or need from your investments. As personal finance is just that, very personal to you and your life, this could be a big negative. However, that being said, these funds have for the most part achieved exactly what they say on the tin, which is getting your money to grow, and it may not end up being such a big of a deal. Thirdly, these funds can work out to be pretty expensive over time, as they tend to consist of other funds with their own costs. So beware when selecting your life cycle fund. Check the fee, but honestly, don't be dogmatic about it. I had one of these funds in my pension account, and I chose it because it was dirt cheap. After a number of years of below average performance, I finally got wise and changed it into a slightly more expensive, but hugely better performing fund. So yes, watch the costs, but also check out prior performance, at least over the last 10 years in terms of a time frame. The second type of investor is the meal kit investor. And you are the type of investor who's partial to HelloFresh in the UK or Blue Apron in the US. So you are a little intrigued about investing and you do want to get your hands dirty, so to speak. but you don't have the time or the inclination right now to research individual stocks, and bonds, and other investment classes. In addition, you don't have a large amount to invest right now, or you don't want to be investing all the amount you do have available. But you do know that you need to diversify your investments and you don't want all your eggs in one basket, so to speak. And you understand that the best way to diversify is by investing in funds. So the meal kit investor will set up either a tax efficient structure such as an ISA or a SIP on an investment platform, or even a taxable structure such as a general investment account on this platform. Ideally, you want your platform to be a fund supermarket, and that means it just has a wide variety of funds from different asset managers. In the UK, for example, that would be Hargreaves Lansdown, Fidelity, AJ Bell, and such. Now, before investing, the investor, whether it is a meal kit investor or a life strategy investor or whatever, has to understand two things. Number one, your timeline. And if it is less than 5 years, then you don't invest in the market because you need to give your money time to work and grow. Secondly, it's good to have an understanding of your risk tolerance because this informs how many risky assets you want in your portfolio. For example, how many funds do you want with equities, because this is seen as a higher risk asset, and how many funds you want with bonds, which is seen as a lower risk asset. The meal kit investor who's starting out with a smaller amount to invest will initially start with a global equity index tracker fund as the starter fund. And take as your lower risk asset potentially a cash balance. As you get more confident with investing, or the amount you have available to investing grows, you can then start adding other funds to get different levels of diversification in your portfolio. The right number of funds will vary depending on your investment objective, your tolerance for risk, and the money you have available to invest. But generally, a rule of thumb is to have between 2 and 8 funds. And ideally, when you get more funds, those 8 funds, you want them to cover your domestic market, your small, your mid-size, and your large equities, your domestic bonds, and you want them to look at a global market. So you have global equities, including emerging market equities, and global bonds, and also some maybe commodities and properties. So let's take a look at the pros and cons of the meal kit investments. The obvious pro is that this portfolio can be tweaked to match your investing requirements to a much larger extent than the life cycle fund. If you are excited about the future of technology, you can invest in a technology fund in your portfolio. If you believe in portfolios consisting of female-led companies, you can invest in a fund that invests in companies advancing female leaders, and so forth. This allows a much more hands-on approach to investing without you needing to have large sums of money to create a diversified portfolio of individual shares. And as an aside there, it's been said that to create a diversified portfolio of shares, you'd need to invest in at least 20 different shares. And this is a rather daunting task if you are starting out investing. The meal kit investor, because it's more hands-on, it means you build your investing ability and your investing confidence. The first con, though, is that you are literally learning as you go. And I can attest to the fact through personal experience that you will make some rookie errors along the way. But you have the guardrails of having a diversified portfolio of funds, and so it's unlikely to be a major disaster. And to be perfectly honest, many of my rookie errors arose from the simple fact I didn't want to risk looking like a fool by asking the questions that would have prevented this. So, ask the questions. The second con is that the costs can add up, especially if you start adding actively managed funds into your portfolio. You will do fine, if not better, by rather selecting the passive index tracker funds that carry a much lower cost because they don't have the expensive fund manager trying to outdo the market. And as an aside, it's been proven that they seldom do anyway. Finally, we have the cook from scratch investor. And this investor is totally captivated by the stock markets, the different asset classes, and the goings on in the global economy. They have the time and the inclination to do the necessary research and to continually build on their knowledge, and they have the financial resources to build up a well-diversified portfolio within a very short space of time. This investor will similarly create an investment account on a platform, and their first port of call would be to do so in a tax-efficient structure such as an ISA or a SIP in the UK. They will be able to invest in shares listed in their stock exchange through their platform. When selecting their platform, they should consider the following: the cost of the investment account, the cost of trading the shares, and research the platform will be providing, as well as the support the platform provider gives you. A low-cost provider may seem like a good bet, but I would definitely say good research and available, accessible, and useful support should not be overlooked. It comes in incredibly handy. Let's now take a look at the pros and the cons of the cook from scratch investment. The pros are clear. If you find researching investments fun and enjoy the thrill of being an official owner in a company, this is definitely your investment style. The cons, however, are that it is time consuming and it carries a much higher risk, being a much more concentrated approach to investing than through the funds. But as a result, there is a potential for a lot higher rewards. And of course, it carries a lot higher costs than investing in funds. Investing is not a one-size-fits-all game. You get to choose how you want to do it. And maybe your style isn't clear-cut and you want a bit of each approach in your portfolio. I know I do, and I have. But whatever your jam, there is an option. I hope you see that you don't need a financial degree or tons of money to invest. There is an option for you. You just have to decide to take it. If you're ready to start investing, grab the Investing 101 How to Get Started Investing guide below. If you liked this video, please let me know by hitting the like button. And if you know any other ladies who want to change their financial story or are interested in financial education, especially designed for women, please point them to my channel. If you like this video, please subscribe to my channel and hit the bell to be notified when I post a new video. It's been great speaking with you.